everybody. Cameras on, please. We are going to go over these sample exam questions in a second. Remember that I will distribute the instructions for the exam before the exam period begins, which I believe it begins 2 weeks from yesterday. So it'll probably be up the Friday, at latest the Friday before the exam week begins. Again, there should be no surprises on the instructions. There's not a whole lot of everything you know about it. What'll be most important will be the instructions to access the exam and then upload your answers, which again are pretty straightforward. I've done this before. There'll also be a fail-safe. You'll see in the instructions that if you think you're having issues uploading it back on Twin, that you can email my assistant, and I'll give you her email address, and then she will scrub the answer, what you give her of any identifying information, and then send it to me as well. So, and then I think I've mentioned this before, but you'll have the ability to upload more than one answer, if you will. So if you want to type, I will expect typewritten answers, at a minimum, some typewritten explanation. But if you want to use handwritten tables, then you'll be able to upload a PDF of that as well. So any questions about the exam or procedure or anything? Okay, well, let's take a look at the sample questions. So these are just questions. I mean, so in the exam, you'll see there will be an instruction page or pages. Again, not surprising. You'll see those before. The next page will be an assumptions page. And there'll be assumptions there, like any eligible entity does not check the box to be a corporation, right? Some stuff like that. Or all taxpayers use the calendar year for paying taxes. I mean, all the stuff that we've already sort of assumed. There could be other stuff, again, that you would pay attention to. For example, there could be stuff about 754 elections. 754 elections will be made. And again, those assumptions on page 3 or whatever, it'll say unless otherwise specifically indicated. So these are background assumptions. So it might say all partnerships make 754 elections, but then in a particular problem, it might say, well, no 754 elections made, right? So just be smart about those assumptions. Other assumptions that we've done in class that will be there will be, all property is depreciated straight line basis with no conventions, which means that you don't get half a year, for the year of putting it in. And again, stuff will be put in service on January 1 or taken out of service on December 31. So it'll be pretty straightforward. So again, a lot of those assumptions will be, just basic stuff you didn't even think about before. And then other stuff will be important, again, like elections will be important for you setting up your answer, thinking about your answer. I got a question about how many questions. So I haven't written the exam. Typically, it would be between 3 and 5 questions, would typically be the case. Some questions will have multiple subparts. So I'm looking at this question here. Question 2 is broken into 2 subparts, and question 3 is broken out. So a lot of times there'll be subparts, and that's helpful for me to see, to organize your answers. And so I've gotten more in the habit of having questions with particular subparts. It makes it easier to grade. But yeah, I think 3 to 5 overall questions would be typical. Any questions? Okay, so here So this is, you know, a 704C problem. We've got Mary is contributing property with a large built-in gain. We've got Nancy is contributing cash. So we've got a contributing partner and a non-contributing partner. And this is really kind of it's a planning question. It's sort of, okay, which 704C method is best? And we're representing Nancy, the non-contributing partner. And this just goes to show you that, you know, you really can't figure this out intuitively, I don't think. It's not something that you could intuit. You have to run the numbers. And we have three different methods. We have the traditional method. We have traditional with curative, but we're limiting the cure to only depreciation or remedial. And so we get to choose. Mary's lawyer has given us the ability to choose those three. And so let's figure out under year one what the tax consequences are for Nancy under each approach, and then we can tell her which one's best. So we start with traditional, and we can just put Mary and Nancy up. And we can put book and tax capital accounts up. Here, the tax capital accounts will be equal to the basis, the outside basis, because there's no debt in this partnership, and we're not going to hit the zero floor. So if you want, we can just call it tax capital account and outside basis here. They won't always be the same, but here they are. And Mary's putting in that property with a value of 10 and a tax basis of 2.5. That's property number one, building number one. And so that has a book value of 10 and an inside basis of 2.5. And Nancy's putting in 5 of cash. And then they're going to use that to buy property number 2, building number 2, which has a book value and basis of 5. Because they're just buying that for cash. And we're focusing here on year one. So we need to know what's the depreciation of the properties. Well, property number 2, we're told, has a 25-year recovery period. So we divide 5 million by 25, and that's going to give 0.2 of depreciation in year one. For property number 1, we have 10 years left on the recovery period. So we're going to depreciate the tax basis 1/10 each year. And the general rule for book is it's the same rate. So we would depreciate the book 1 per year. And so let's allocate the depreciation. So with property number 1, that's 704C property. So we have to follow our 4-step approach. Well, we figured out the book depreciation, the tax depreciation. We're going to allocate the book depreciation. We're told the partners are sharing everything 50-50. So it gets allocated 50% to each. Then we give the non-contributing partner, that's N, tax depreciation equal to book, but the ceiling rule comes into play and we only give her what we've got. We can't give her more than 0.25. So Nancy gets $250,000 of tax depreciation. Whatever's left goes to contributing partner, that's 0. Right? Everybody follow that? Make sense? Any questions on 1? 2 is not 704C property. We just allocate that. And by the way, all this has substantial economic effect because, you know, it's 50-50. There's no substantiality issues, and we're not driving anybody's capital account below 0. I think the problem is set up for the alternate economic effect. And so we have the first two. Let me go back to the problem and see. Yeah, so it's set up for the alternate effect here. So that's the language that gives the alternate economic effect. It's not really what this question tests, but to be complete, you would say these allocations are respected because they satisfy the alternate economic effect test. Nobody's capital count is getting below 0. Then finally, we could stop there and we could basically look, and if you look at it, we could sort of add up the deductions that N is going to get 0.35, 350,000 of deductions, and M is going to get 100,000 of deductions. But I decided to make this profitable so that you could actually see that there's a positive tax liability. So we're told that the partnership earns 1.5 million of operating income. That's the 2 million of gross income and the 500,000 of cash expenses. So we're going to have cash up here as well of 1.5. And then we're going to allocate that 50%. So that's our operating income. So what are the tax consequences if we kept a scorecard here so we can go with traditional? M is going to report 650,000 of income on our own return. N is going to report 400,000. Okay. Any questions on that traditional? Okay, traditional with curative, if we can cure only with depreciation, what we then end up doing there is we can say, okay, we have a ceiling rule disparity. We want to get N another 250 of tax depreciation. And we can cure out of this depreciation. So what we can do is, again, we can give N all, 0.2 of the tax on number 2 and give M 0. So we're curing by shifting 100,000 of tax depreciation on debility number 2 from M to N. It doesn't completely cure the problem. It's a partial cure. And in theory, we could cure out of operating income. This is, depreciation is ordinary deduction as long as we can cure out of operating income because that's ordinary income. So if we could completely cure, if we could cure out of that, then we could completely cure. We'd move another 0.15 of this over to there. But what makes this problem interesting is that it's an incomplete cure. And so it's not entirely clear which one's better. But with curative, then M has 750,000 of taxable income in year 1, and N has 300,000 taxable income. So at this point, we could say in year 1, curative is better for N than traditional. She's paying tax on $100,000 less, right? And that kind of makes sense. I mean, that's kind of intuitive to some extent because N is getting hurt by the ceiling rule. With curative, we're at least partially offsetting the ceiling rule. Okay, questions on traditional with curative? Okay, with remedial, things get trickier because we have that special book depreciation rule. So we're no longer depreciating the book here. So this is in the book depreciation rule. We've talked about this before. Is found in 1.704-3 D2. So now we're going to take that book depreciation of 10. We're going to divide it into two pieces. The piece that equals the tax basis, which is 2.5, and the excess book value, whatever's left, is 7.5. And we depreciate the tax basis piece just like the tax basis, which would be 0.25 per year. And we depreciate the excess book value like a new building placed in service on the date of the contribution. Since buildings are depreciated under this fact pattern 25 years, we would divide 7.5 million by 25, which gives us which gives us 0.3. So the total book depreciation for year one is the sum of these amounts. So now the depreciation, book depreciation for year one is 0.55. So now that changes the analysis. So we figured out the book and the tax depreciation. So year number one depreciation, we allocate the book. It's going to be 0.275. 0.275. Give the non-contributing partner N tax equal to book, but ceiling rule. Now we would do remedials. So N is getting shortchanged 0.025. So N gets another 0.025 of depreciation, and M gets offsetting 0.025 of ordinary income. And then number two is unchanged. That just goes 0.1, 0.1. And then the operating income is unchanged. That goes 0.75. So now we can go to remedial here. What are the tax consequences? Well, M is going to be taxed on 675,000. And N is going to be taxed on 375,000. So now once we've done that, now we can rank order and we can say, well, under this set of facts, right, with some, we should choose, N should choose this first, then this, and then that, at least for year one. Now things are going to be more complicated down the road because when we sell the building, remedials are going to be potentially impacted on the sale. So, but I didn't ask you to do that. I just said focus on year one. So that's the answer. So I don't think this problem is particularly hard. I think sometimes, it's this new orientation to be like, okay, what's the answer? Which is much of the battle, right? If you got me the answers, then That's right. But sometimes students get a little confused with, okay, I want less taxable income here. Economically, everything's the same. I mean, this is right. It's the same transaction. The only change is tax. And so it's the same transaction and you want less tax. And traditional with curative under these facts gives you that. Okay, questions on this? Now's a good time for any questions.
I have a question.
Yeah.
I was just wondering what like you would want us to write in the written part of the response, like how detailed do you want that to be?
Okay, so yeah, I get that. You need to explain what you did. I don't need like a treatise. Don't worry so much about, I just need you to tell me what you did. And again, sometimes students will refer to, again, a handwritten table. So it's really, don't really worry about it. Again, you just, don't just give me the answer, but it doesn't have to be a very lengthy explanation. What I would say, the other thing I would say is that if you get the answer right, if I look at, a lot of times if I look at a table and I see that you got the answer right, then I'm just going to go back under your written to make sure, it was your own work, that kind of thing. Where the written explanation can make a difference is if you end up not getting the answer right, you make a math error, or you make some error in your analysis, the more you explain sort of what you did, the more I can give you partial credit. But you just have to use your own judgment here. But I'm not interested in punishing people. I'm not interested in style or, you get the right answer. You told me how you got there. I'm not going to hold it against you if you didn't, elaborate so much. And again, it is where tables can do a lot of the work. Because if you show me something that looks like this, I pretty much know what you did. I just want to hear a little bit of just explanation. But so another way to say it is that, people have gotten very high grades in this class with writing a lot. People have gotten very high grades in this class with not writing that much. Any other questions on this? And again, make sure you answer the questions, right? That's the other thing is I try to be very precise in what I'm asking you, and I'm not asking you to answer anything I don't ask you to. So if you spend time answering something I didn't ask you, that's not going to hurt you other than the fact that you're wasting time. So please just read the question very carefully, read the prompt very carefully, and answer the question that I ask. And here, just going back, the question I ask is, determine how they affect the near-term tax liability. So what I wanted to see is, and then which one's best. And so I wanted to see, the answer really is this right here, this on the right side.
How did you get the figure for the tax liability, the 650 and the 400 example under the traditional? Are you subtracting the book from the tax?
No, this is just adding up. So this is the tax account. So I'm just adding. So this is 675 for M for remedial. That's 750 minus 100,000. That's 650 plus 25,000, 675. So it's this column right here. This is your tax. This is what goes on the tax return.
Okay, and you don't count in the original what they put in.
No, I mean, again, because this is what's going to be reported on their tax return in terms of like the K1. This is what M's K1 is going to show. This, and N's K1 is going to show these. Now, again, we could have issues if there's not enough outside basis to absorb, but we end up positive here. So none of these losses are going to get suspended. In fact, again, we have a net positive this year. So, and again, I could have asked this question I could have said, okay, well, they break even, leaving aside depreciation. That would have left this out. This line wouldn't be there. And then you would say, oh, M is getting taxed on, is getting net 0.75 depreciation, and N is getting 375 depreciation. I mean, I just decided to put us in a positive tax situation. So you could say that, okay, N is paying less tax, the least tax here. Because again, if he's in a loss position, then, you know, N might not care if N has losses elsewhere. So anyway, but the tax, well, I'm asking what are the tax consequences? And it's basically what's the depreciation flow through and what's the ordinary income, the operating income flow through. The operating income flow through is always the same. So it's really just the depreciation, tax depreciation. All right, moving on to problem 2. So this problem, you know, not that exciting of a problem. It's basically like some mechanics of constructing balance sheets. So here we've got O and P, and we're asked to do the book and tax capital accounts. I mean, it's kind of silly to do the tax capital accounts here because there is no 704C property. So it's going to be redundant of the book capital account. So I probably wouldn't ask you to do tax capital accounts now. You get a little older and wiser. But anyway, we can do tax capital accounts. It's just going to be redundant.
If that was on the exam, could we just dispel that at the beginning? And
I wouldn't. But again, yeah, I mean, just answer the question. If I ask you something stupid, I won't. But if I ask you something stupid, just answer the stupid question. But I won't. I've gotten better at that. But anyway, we'll answer this question. So here, what do we got? We got O and P. It starts out really simple. They borrow, they put in a bunch of some cash each. So O and P each puts in 50 of cash. So they get 50 across the board. The company borrows another 100, buys equipment for 200. 5-year property, depreciated over 5 years. So now we've got debt. Once you have debt, you know that the partners share the debt, and the aggregate has gone up from 0 to 100. They didn't have debt before, now they do. So we're going to have constructive contributions of money by O and P in some fashion. And so now we have to determine who gets the share of the debt. Now this is an LLC, which we didn't talk very much about LLCs, but LLCs, I think we know that LLCs are not, that have limited liability for all the partners. So there's no vicarious liability. But to induce the lender, P agreed to guarantee the debt. So P says to the lender, look, I'll pay the debt if the LLC doesn't pay it. And typically in a closely held business, the lender is going to require some sort of guarantee by the members. Right? This is famously Donald Trump, issued personal guarantees to induce lenders to lend. Because the lenders know that an LLC is closely held, may not have any cash or property, and so you need something to back it. So the hypothetical liquidation is we would liquidate for 0. We sell the equipment for 0. We'd allocate the loss. Everything goes 40. So we'll do the hypothetical liquidation. I'll do it in red. So the loss would go 40% to O. So that would be an 80 out of 200. 60% to P would be 120. O's capital account would appear to be negative 30. P's capital account would appear to be negative 70. Nobody's required to restore capital account balances, as I recall. So what that means is that this is basically funny money. Nobody really cares about negative capital account balances, but P is still going to be on the hook pursuant to her guarantee. So P is going to ultimately end up paying the 100 back to the lender. So P bears the entire economic risk of loss for the 100 of debt because she has a guarantee. There's no, subrogation rights, if you will, because this is a limited liability company. So even if P is subrogated rights to the lender, P doesn't have any recourse against O. We did a problem that was similar to this, where if P was a limited partner and G was a general partner, then O would end up getting it, because even though P might be called to pay the guarantee, P then steps in shoes of the lender, and then the lender can go against the general partner with limited partnership. So the fact that this is an LLC means that P gets the entire debt. And so this is a constructed contribution of P under 752A of 100 of cash. 100 cash deemed contribution increases P's outside basis by 100. Any questions on 752A? Again, just in terms of, partnership borrows, you gotta increase the outside basis of the partners to some fashion. 752 regs will tell you how. Another thing to note is that there's not going to be any non-recourse deductions or minimum gain issues here, because you only have minimum gain and therefore non-recourse deduction issues if the lender's right to repayment is limited to the asset. And here, a lender's right to repayment is not limited to the asset. It's P also has a guarantee. So we go to 2012 and we got depreciation on the property. And again, we're told it's 4-year property. So we have, 5-year property. So we have 40 per year. So we have 40 of depreciation. We're told everything else in 2012 cancels out. So we're just left with a depreciation. And so 40% under the agreement goes to O and 60% goes to P. We test that for substantial economic effect. It has economic effect. The first two of the big three is satisfied. We have a QIO and capital accounts are not dropping below 0. So the allocations are valid on substantial economic effect. There's no issues about flow through loss. We're not trapping any losses because we have enough outside basis as well. So O is going to report 16 of depreciation. P is going to report 24 of depreciation on the tax return. Substantiality is asked separately. There's really no substantiality issue. You need to have some sort of offsetting allocations. If everything's going 40-60, then you don't have a substantiality issue because you can't construct different, there's no baseline. So this is not really testing you on substantiality. 2013 depreciation, it's the same thing. You got another 40. Again, we don't have any, we have substantial economic effect. And again, the interesting thing here is that P's capital account is now down to 2. So getting close. But we also, in 2013, we also have a sale of the property. So we're told on December 31, we sell the property for $150. So our book value and tax basis is $120. So our amount realized is $150. So we've got 30 of gain. And again, that gets allocated 40% and 60%. And so really in 2013, we have a net downward adjustment of 6 for P, and we've got plenty of capital account. The next thing we do is we take that 150 of cash, and so now we've got 150 of cash, but we're going to take 50 of it and pay off 50 of the debt. Now we got 100 of cash left. We pay the debt down to 50. So now P share of the debt goes from 100 down to 50. So that's a constructive distribution of money under 72B, reduces P's outside basis by the amount of cash. There's no gain under 731A1 because we have enough outside basis to absorb the entire amount. And so when it's all said and done, the accounts look as follows. And I wanted you to do a balance sheet. You would sum up at the end of 2012. I think you sum up at the end of 2013 as well. Yeah, 2012 and 2013. And then 2014. So 2012 is formation. 2013 is immediately after 2012. So let's go back. The 2012 balance sheet would be here. The January 1, 2013 balance sheet would be summed up there. And the 2014 balance sheet would reflect that. That's a pretty boring problem. And it's basically just, can you construct a balance sheet? 752, probably the least intuitive stuff is just the 752 stuff. Again, remember that when you have debt inside the partnership, you've got to apportion that debt and deal with it. I got a question. Should you cite every code section? So again, this is similar to the question before. You need to explain what you did. Some students like to cite code and reg. It's a good way to learn and study and to explain. And so probably if I were in your shoes, I would probably do a lot of citations, kind of a shortcut. But it's not the only way. I'm not a stickler. I'm not looking to ding you. So if you say things like substantial economic effect or capital account maintenance rules instead of citing the code section, or if you say there's the deemed distribution does not result in gain because the outside basis exceeds the cash distributed, and you don't cite 731A1, that's fine. Or you could just say, so I view the code and regs as sort of a shorthand approach to explaining what you did. And so, again, I think it makes sense to do it that way, but I'm not interested in, if you get the right answer and you explain what you did, there's no magic words you need to use to get credit. Okay, any other questions on 2? Okay, on 3, so 3 is just a substantiality question. It's a ripoff of, we did this reg example. We spent some time on this reg example, 1.704-1B5. That's our list of examples, and we did example 5. We had a high bracket taxpayer and a low bracket taxpayer. The partnership had taxable income and tax exempt income, and there was a range, and they were going to specially allocate the tax exempt income disproportionate to the high bracket and the taxable income disproportionate to the low bracket. And we were applying the overall tax effects test to say, okay, could anybody lose? Right, under the setup, could anybody lose? And so this is the same sort of thing here, except, again, a trick is going to be if I tell you stuff about the partner's own tax attributes, that's a clue that substantiality is an issue. Because absent that information, you can't do a substantiality test. And so here I'm telling you, you've got one partner that is in a high bracket for both years. The other partner is an exceptionally low bracket for 1 year because that partner has a net operating loss carry forward that's going to expire in exactly 1 year. Now, just to be clear, since the 2017 Tax Act, net operating losses now don't expire for individuals. They carry forward each year until they die. In the past, NOLs would carry forward and expire after 15 years or 20 years. The law had changed. Again, it's not really important. NOLs is set up. I explained to you that basically you have a 0% effective rate for 1 year and then it goes away. And then you're back up to 40%. So you have 1 year where you're really in a low bracket. And so you can envision what the tax lawyers are going to want to do with that 1 year. And they're going to want to say, let's get a whole bunch of income this year because whatever we get is tax-free if we have a very large expiring NOL. The reason why expiring makes it important is that if it continues to carry over, then by using it this year, you're not gaining as much because then you have less to use next year. But when it expires completely in 1 year, then whatever you don't use this year is gone. Use it or lose it. So we're told that N has the NOL and M doesn't. And we're told that there were 50-50 partners. Let's go back to the problem. So there are 50-50 partners. For a long time, they've been 50-50 partners. So there your baseline jumps out at you. We talked about how in the real world, it may be difficult to figure out the baseline that you compare the special allocation regime to. But in the problems we did, the baseline kind of jumps out at you, and here the baseline jumps out at you. Everything's been 50-50 forever. And now they decide, okay, we're going to change this up. And what we're going to do is we're going to give 90% of year 2. We're in year 1, so year 2 is going to be allocated to N, to the guy with the big NOL, the remaining 10% to M, and then the following year, year 3, all the income will be allocated to M. And importantly, we have what we know, we use our crystal ball, and we see that we're going to earn between 800,000 and $1 million of net income in each of the 2 years. And we're told basically to apply the overall tax effects test. So what we do then is we run hypotheticals. And we're going to see, can any partner be worse off? So let's start with M, the taxable partner. Well, M is getting 100% of year 3 and only 10% of year 2. Whereas before, under the baseline, get 50% each. So M is likely to be worse off, if she is going to be worse off, most likely, in a situation where the year 1 income is maximized and the year 2 income is minimized. So if we have 1,000, I'll use year 2 like the problem does, and 800 in year 3. So under the baseline, M would have gotten 50% of each, as would N. And then with the special allocations, is going to get 10% of year one, and we'll get 90%. And then M is going to get all 800 of year two. And M is in a 40% bracket both years. So now we basically say, and this is M going to be worse off here? Again, this is the case that's going to maximize the likelihood that M is going to be worse off because we set it up to where his bet that he's making is basically making this bet that year two is going to be high relative to year one by giving up. I'm sorry, year three is going to be high relative to year two because he's giving up a big chunk of year two to get a big chunk of year three. And he lost this bet, but he still is going to be okay. And one way you could look at it is in both cases, he's being taxed on, his capital accounts are the same, plus 900 for each. And here, M is getting taxed on 500 in year one and 400 in year two. Here, M is getting taxed 100 in year one, year two, and 800 in year three. So I told you could just ignore the time value of money. And if you ignore time value of money, M is in the same exact spot. His capital accounts are the same, and his total tax liability is the same. It's 900 times 0.4. If you add time value of money, actually M is better off because he's deferring 400 of income from year one to year two to year three. Because instead of being taxed on 500, he's taxed on 100. Instead of being taxed on 400, he's taxed on 800. So actually M is better off. But I was fine getting, if you ignore time value of money, you would say M is no worse off, no better off, no worse off, same spot, taxed on the same amount, capital accounts, same amount. Okay, does everybody see that? So M can't lose. You represent M, again, leaving aside the fact that the IRS can recharacterize, the IRS respects, you would say to your client, you can't lose. It's a no-brainer. What about N? Let's go to N. Can N lose? So the worst case for N is going to be the flip side because N is getting a large amount of year two and none of year three. So under the base case, they would each be allocated 400 and then each 500. With the special allocation, N is going to get 90% of year two, M is going to get 10%, and then N is going to get 0 of year three, and M is going to get all of year three. And so then we say, is N going to be worse off after tax? Well, it's pretty easy that in this case, N is going to end up with 720 after tax because it's, again, the 0% tax rate in year three. So N has 720 after tax. Here, N is going to get 400 after tax here, but then only going to get 60% after tax for that because, again, year three pops back up to a 40% bracket. So N ends up with 400 plus 60% of 500, which is 300. He's going to end up with 700 after tax. So N is better off in every case as well. So N can't lose. M can't lose and N can't lose. Nobody can lose. That means that the overall tax effects test is violated and these allocations are insubstantial. Okay, so that's the answer to part 1, little I. Is the economic effect not substantial? Yeah, it's not substantial. And the reason is neither M nor N can lose. And we showed that by sort of going straight to the situation where they most likely could lose and determined that they can't lose, that they don't lose. Under the most likely case, they would lose. Again, you could run every other permutation and they wouldn't lose, but we just jumped to the chase, you know, and sort of said, okay, if they could lose, this would be a situation where they could lose, and they both don't lose. In 2, now we have to say, okay, now that we actually have something that, remember, the year, this test is tested on December 31, year 1, using the crystal ball and trying to figure out what's going to happen in the future. Then we get year 2. What actually happens is year 2 is 800 and 900. So that's what actually happens. It's within our range of expectation. So it was 800, 900. And now we have to reallocate under partners' interest in the partnership. And that same reg example, -1B5, example 5, one little I does the analysis to say it's insubstantial, and then 2 little I's explains how you reallocate when you have substantiality failure. So we're just going to apply that same approach. And what it says is you're going to keep the capital accounts the same. You're going to just change what they're comprised of. And so what ends up happening is, so this is what actually happens. So we've got M and N. We've got 800 in year 1, year 2, sorry, doing that. 900, year 3. So again, N's going to get all 800, I'm sorry, 720, 90%. Under the agreement, N gets 90%, M gets 10%, and N gets all of this. And so at the end of year 3, our capital account adjustments are as follows. And so what that reg example says is, well, you're going to take a proportion. You're going to say, okay, M is getting 980 over a total of 1,700. That percent is 57.6%. N is getting 720 out of a total of 1,700, and that comes to 42.4%. And so when you reallocate, we're going to just give M and N, M 57.7% of each year, and N 42.4% of each year. So we're going to end up again at 980 and 720. But M is going to get 57.6% of 800 for year 1, which is 461. And N is going to get 42.4% of 800, which is 339. M is going to get 57.6% of 900, which is 519. And N is going to get 42.4% of 900, which is 381. So year 1 income is going to get allocated 461 and 339. Year 2 income is going to be allocated 519 and 381. And of course, that really hurts N, because instead of N having all the income in year 1 where it's tax exempt, more than half of it comes from year 2. but that's the reallocation again. It's just this is a ripoff of 1.704-1B5, example 5. So we went over that in class. To get comfortable with that approach, again, it would have to be a problem that looks like that, where I tell you that partners own tax attributes, I give you a crystal ball projection, and you again can kind of jump to the worst case scenario.
When I read this question, I thought that you were giving us those numbers in year 2, the actual numbers to use those. So if you use those compared to the baseline, would that change the answer in any way?
Right. Yeah. Well, again, it's if you know exactly what's going to happen, then you can know. Then you don't have to do this range. But yeah, this is again much like that problem example 5, that you need to test it with this range. Just because something happens doesn't mean that that's the only thing that can happen. And so that would make it too easy. If I told you exactly what's going to happen, then nobody's worse off. So no, you're supposed to analyze problem one little I. You don't need this sentence is irrelevant for one little I, because it's all about what we think is going to happen. This sentence is relevant only to part 2, which is how do we actually allocate once it happens. So there's a subtle distinction there, but yeah, we use crystal ball to apply the overall tax effects test. And then once we have a failure, then we wait and see what happens and then reallocate based on what happens. Any other questions on 3?
I have a quick question.
Yeah.
If you had chosen 800 for year 2 and 1,000 in year 3, so basically like switched your range usage, is it all that matters that they're the same after the baseline and then the other range, or like, is there a reason you chose 1,000 for year 2 and 800 for year 3 for the baseline?
Let me see. I'm trying to understand. For the baseline, so the baseline. So what we did is, we went to the worst case scenario. And again, because if you think about it, again, M is really like, if it wasn't for tax and somebody did this, you would think, okay, M is making this bet that year 3 is going to be bigger than year 2, right? And N is making the opposite bet. And so we're looking to see the situation where you're the most wrong about that bet. And the most wrong is always going to be at the very ends, where year 2 is going to be the lowest possible and year 3 is going to be the highest possible, at least for N, and vice versa. So I don't know to answer that question. Did I answer your question right? Kind of jump.
Yeah, I was just wondering if it like really mattered which end of the range you applied for your baseline, but that answers the question.
Yeah, I mean, you needed to, because again, the key is to sort of figure out which ends you're going to use for which partner, which sort of extremes you're going to use for each partner. Because if you end up using M's worst case scenario for N's going to show a huge gain, right? I mean, basically, whenever M is, so let me put this differently. So again, we went to, which one do you want to do? Worst case for M or worst case for N? Abigail.
Let's do worst case for M.
For M, so for M, again, so worst case for M, because M is getting the smallest amount of year 2 and the largest amount of year 3, we're going to say, okay, 800, and then, I'm sorry, M is giving up year 2 to get year 3. So we ended up here where N would get, so that's with the special allocations. And then the baseline was 500. And so we were focused here on M and said M's not worse off, but just look at N. N is much better off. N ends up with 900 after tax here because it's all tax free, and N ends up with 500 after tax here, and then 60% of that. So N ends up with 500 plus 240, 760. So worst case scenario for M is best case scenario for N, where N goes from 760, improves by 760 to 900. So you're always going to use extremes, and the key is just to figure out which extreme is you're going to apply to each. But if you kind of screw it up and you say, oh, we're going to do the extreme here, you're going to see one partner is just, obviously not worse off. This is what N wants. N prays for there to be huge amounts of year 2 and low amounts of year 3. That means N's bet really paid off. So it's always going to be an extreme, and again, you just have to intuit which one is applicable for each partner. And again, you're basically asking, what's the case that's most likely for a partner to be worse off? So I don't know if that was a good explanation, but again, one way to deal with this is just go through problem 5 again, just kind of work that problem again, work this problem again. And, I think it eventually becomes pretty clear. And again, it's going to be a setup. If I did test you on something like this, it's going to be a setup like this, where there's going to be a situation where we've got tax attributes that we can arbitrage. We've got a crystal ball projection here. That's going to do the work for whether we have a substantiality failure. And then if we do have a failure, then, we then have to do the actual remedy, which is then we have to actually know what happens. Any other questions on this? So I have to say, one thing I have to say is that these problems are probably look more different relative to what we went over in class and what the exam will look like, that I've gone to more like being less creative in my problems and doing more, looks like stuff we've done in class. And so if this seemed a little bit odd or unusual or whatever, I don't think this is that hard. I think I could test you on stuff just like this. I don't think it's beyond the pale, but it's more likely that, when you see questions on the exam, they're going to look more like what we did in class. But this is a little more creative of me to sort of come up with questions. I mean, 2, it's just a balance sheet question, but yeah, that takes some work to do a problem like 3. And 1 is really, again, I could have just asked you, what are the tax consequences under these 3 methods? But again, that's 90 whatever % of this problem. So if you got all that right, I'd be really happy with that. The stuff we didn't really talk about in class is, well, okay, now take it one step further and say which one's best, which, I hope, well, now you all know that how to answer that question, but maybe without priming you for it would have been a little bit harder. Okay, any questions? All right, well then, as I mentioned, look for the instructions. Feel free to reach out with questions by email. We could set up a phone call or a Zoom. And good luck on the exam and have a good summer. Okay, bye-bye.